In this week's video, we'll review the latest charts, data sets, and studies to help us understand why the window of opportunity for stock bulls is closing rapidly. We've got a tremendous amount of material to cover. The video has been designed so you can use the pause button on your video player. As covered in Jamie Dimon's letter to shareholders released this week, in the present day, we're dealing with a completely different set of circumstances than what we've all experienced in the past, which means the concepts on the screen are more important than ever. We'll be covering facts that lean bullish this week and facts that lean heavily towards the concerning end of the spectrum. Let's start with something positive. Nasdaq 100 advanced decline weekly. Here's the present day on the right side of your screen. Pretty easy to make the argument that after the major low in 2009 that this look here is similar to the look on the right. In both cases, we get a close below the lower Bollinger Band, and in both cases, we get a bullish divergence here, a higher high while price is still making a series of lower highs. With this look here in 2010, QQQ was trading at just under $40 a share, and in this case, good things happened from that point walking forward. QQQ tacked on 30% from this look here to this period here in 2011. Is there anything else in the present day that tells us to keep an open mind about better than expected outcomes in the tech-heavy triple Qs and/or XLK? The answer is yes. This is a weekly DeMark chart. DeMark charts and indicators are proprietary tools from Market Studies, LLC. This is XLK weekly. If you know DeMark, there's a lot of developments here that tell us to keep an open mind about surprising upside, including these teal targets up here that are roughly 32% above where the market was trading last week. NYSE Advanced Decline Volume Weekly put this in the concerning category, still has work to do to start looking more like this. Top portion is the Nasdaq Technical Index. Somewhat of a tepid look here. It's positive that it's trying to base, but this is a lower high here relative to this high here. This looks worse than price. From this point here, let's say Q1 of 2021 to the present day, we have all kinds of relative breakdowns with anything that has to do with technology. It's possible the last standing ETF is XLK. Resistance, support, coming back down near that area of possible support. This is as of the close on April 14th. Notice here when we held, interest rates had already calmed down as we approached the same general area. That's not the case in the present day, telling us to keep an open mind about a break here. Pause your video player here. This is a key battleground between energy and tech, this gap here. We're still in that general area today. This is a breadth chart, NYSE common stock only, that we covered last week, and we also conducted a study that helps us keep an open mind about much better than expected outcomes in the stock market. If we look at the same chart at the end of this week or roughly a week later, nothing particularly alarming here yet. Probably put this chart in the glass half full category. Covered this one many times, starting to lean towards glass half empty. As investment grade corporate bonds, a look at the credit markets. There's no question here. This is concerning until something changes. Let's shift gears and see where we stand year to date on these topics. This was the hypothetical 4 to 15% drawdown chart that we covered for the S&P 500 in January of this year when the S&P was trading up here. And you may remember we used these reference points over here based on this data set, and this data set. Where do we stand relative to those reference points as of the close on April 14th? All of this would probably fall into the glass half full category. Why? Back in January, we said a 4 to 15% drawdown wouldn't be shocking. We've stayed within that range so far year to date. Came down into this area here, which is right in the range that we just talked about via the last three data sets. Like everything else, these are just reference points. If we move into this area here and start to drift from those scripts, then we'll learn something about increasing bearish probabilities. This is the summary slide from April 1st relative to the 25 breadth signals that we covered. And back then we said we don't trade historical studies, they help us assess odds. Thus, to do that, it might be helpful to update this hypothetical drawdown chart based on those studies. This is April 1st. Nothing alarming yet, but we're starting to push into a territory where bearish probabilities would start to pick up. Might be helpful to look at the 200-day moving average in isolation. April 14th is 101 calendar days after the S&P 500's major closing peak on January 3rd. 200-day moving average still looks pretty good. In fact, it looks better than it did 101 calendar days after the October 9th, 2007 peak. Same concepts here. This is the summary slide from the April 8th video. Let's check in and see where we stand relative to this data set here in terms of the hypothetical drawdowns based on those studies. This is April 7th here. This is April 14th. The same basic message. Not all that alarming at this point, but getting more concerning by the day. Also noteworthy, just 6 sessions ago, we were above an upward sloping 200-day in red and above a trying to turn up 50-day in blue. Not the case as of April 14th. Still a battleground, still indecisive in here, but 4 out of the last 5 sessions have been negative. Let's link back to this study based on this data set here. Also helps us keep an open mind about much better than expected outcomes looking out 1 month to 5 years. One of those cases was the 2008 case. You may remember it really didn't look a lot like the present day case. Here are the drawdowns with the 2008 case removed. And relative to those cases, our present day drawdown is really still within that sweet spot, telling us to keep an open mind about the market making a stand somewhere in this general area. And at this juncture, it's also helpful to keep in mind, relative to this figure, and this figure, on the other side of 10 to 15% corrections in the S&P 500, going back to 1980, the return on the other side, roughly 22% looking out 1 year. Covered this back on January 21st. Where do we stand relative to your average and median correction in the Nasdaq? Here's the peak in the Nasdaq here back on November 19th of last year. And so far, really nothing out of the ordinary relative to these figures here. The attempt at an inverse head and shoulders pattern on the Nasdaq 100 for now remains intact. The CCM market model tracks over 230 ETFs. Let's see what we can learn relative to the latest data. Triple Qs still have some good reference points below price. And in terms of the market's overall risk-reward profile, it's relevant that our SP, or the equal weight S&P 500, looks quite a bit better than SPY. Markets like symmetry, so this would potentially be your left shoulder over here where my cursor is. This would be your head down here. If you're forming a right shoulder hypothetically, you would like it to stay above this line here. And thus far, the broad market has done that. A lot of tech stocks are pushing this line down here and don't really have a large margin of error in terms of keeping that potential pattern intact. The same thing could be said for growth. In fact, you can make an argument on a closing basis. The look of that pattern is already starting to break down for SCHG. The dotted line is based on closing prices, so we're in that general area. As of a close on April 14th, if you use high-low close bars, you could come all the way down here and hypothetically still keep the hope alive for that inverse head and shoulders pattern, which is a possible pattern. It doesn't become a real pattern until you break the neckline and hold above the neckline. At the end of 2021, semiconductors relative to XLE or energy stocks way up here and really in a holding pattern, moving sideways. A lot's changed since then. This potential area of support, we've broken it. We're down here. This was a relevant area here, this big gap. It looked like just a few short sessions ago that we were going to try to reclaim that gap, but now we've gone on to make a lower low. If we look at XLK relative to XLE, similar situation. This closing price here, after a little bit of a pop, is now below this close here. This will probably be your next logical reference point. The oil ETF BNO relative to the S&P 500, you can see in March oil took a break relative to the market, and now it's trying to resume that uptrend. The high-low close look here, the closing look on the left side, and RSI from this tweet here, they all speak to dissipating momentum, trying to hold somewhere logically, and possibly that momentum is now trying to turn back up in favor of energy and commodities. That falls into the to be determined category. Having said all that, this is an extended look on the trend short term. It's possible this ratio needs to come back into the moving average cluster. Similar concepts here, natural gas relative to the S&P 500, taking a little break over the past few weeks, but on Friday made a new closing high on a relative basis. The same concepts here, commodity basket, GSG, energy, agriculture, metals, livestock, and precious metals. This is your extended momentum look over here, RSI. But you've come back and held around 50, and if you're turning back up from 50, that typically would be a good sign relative to trying to maintain this bullish trend. Materials trying to follow energy and get a relative breakout. The ratio here in October of 2018, the exact same place in May of 2021, and in the exact same place for the most part today, with the exception of that we closed higher than this level on April 14th and higher than this level here on April 14th. The longer it holds, the more meaningful it becomes. Of course, all of this is tied to interest rates. When you're getting a breakout in this direction here, that aligns with getting breakdowns in this direction here. This is the triple Qs relative to SPY, same concepts. Been in a range for a very long period of time. It's possible this is a bearish breakdown from the range. Those probabilities would increase if you make a lower low relative to this low. Very, very similar situation, potential breakdown, growth ETFs relative to SPY. This is VUG relative to SPY. Semiconductors relative to the S&P 500, and then semiconductors relative to XLK. Have to ask ourselves, what does it say about future economic expectations when semiconductors are breaking down relative to defensive staples? Are semiconductors breaking down versus defensive staples? Energy stocks for now still solidly in uptrends. Been bouncing around here in this ratio since Q1 of last year. Looks like value is trying to finally break out relative to growth. Still hasn't made a higher high relative to this high. When we see defensive leadership like this, it tells us that we should be careful with market leadership, and for the most part that would be energy and commodities. Because if everything moves to a risk-off position, it's possible that they could deteriorate next. This is value stocks of ETV relative to XLP. This is your risk-off look here during the COVID plunge. Here's your risk-on look here, that sharp rally that started in November of 2020. As of April 14th, the VTV XLP ratio is taking on somewhat of a bearish breakdown look, underscoring this point up here in orange. Consumer staples XLP relative to SPY close on April 14th, made a new closing high after this period of consolidation, closing high here above this high. We also exceeded the intraday high here. See, over here, when this acts as resistance, the trends are going against value. Here, when it acts as resistance, the trends are somewhat mixed. Not the case here. We have a turn-up look. We're trying to exceed these levels here. The fact that this ratio hasn't made a higher high above this level, and the fact that the XLK SPY ratio is still within this rising trend channel, it tells us to keep an open mind. It's possible we could get a move in this direction, and it's possible this ratio does not exceed this high. Not assuming anything, let's see how it plays out. We should know something very soon either way. So you can see we don't really have a clear breakdown tech relative to the S&P 500. Same thing here. We don't have a clear breakout RSP relative to XLK. We flip it back, SPY XLK. No clear breakout VTV yet relative to XLK. We've got defensive leadership, including dividend stocks, and no clear breakout here. That doesn't mean that all of these charts aren't about to break out, but we trade the chart in front of us, and right now this is relevant until something changes. But as we've said for several weeks, this breakout of energy from a similar pattern relative to tech tells us to keep an open mind about all of these charts as well. These indecisive battles, mainly based on interest rates, have been going on for a long time. Ratio here earlier in April, same exact place in February of 2020. There's no question that energy and commodities have been leading on shorter-term time frames. How do they look on longer-term charts? Uranium relative to the S&P 500, URA relative to SPY. This is the 50-month moving average here. The ratio is above the 50-month in blue, and the 50-month is trying to turn up. Also have a cross between the 10-month moving average in green and the 50-month in blue. This tells us that uranium could be in the early stages of a longer-term trend in terms of leadership relative to the S&P 500. From a shorter-term perspective, it's good to keep in mind that this high here and this high here could act as potential resistance for the ratio. If we look at the CRB index relative to the S&P 500 on the left side, XLE, energy stocks relative to the S&P 500 on the right side, pretty easy to see that both of them have been in long-term downtrends, especially when we zero in on the period from 2011 to 2021. Thus, it's not surprising that over that period, stocks crushed commodities. The S&P 500 was up about 280% between December 31st, 2010 and December 31st, 2021. Over the exact same period, if you invested in a basket of physical commodities or the CRB index, you lost about 30%. These figures, again, are year-end 2021. And if we look at the chart, year-end 2021, we really didn't have anything in hand that told us this looks like anything other than a counter-trend move within the context of an ongoing downtrend. In fact, late in the year, we even gave up the 30-month moving average down here in red. Having said that, on December 31st, this is a subtle change. Never made it back to the red moving average or the 30-month in red during this period here. This is a little bit different. So if we look at the same charts, fast forwarding from December 31st to April 14th, you would expect to see significant improvement, and we do have significant improvement. The ratio is now above the 50-month moving average for the first time in a very long time. Same thing with XLE relative to SPY. We zoom in on similar charts and add the 10-month moving average. In this case, we're looking at the CRB relative to the S&P 500, and here we're looking at Exxon relative to the S&P 500. But there's no question we have improvement. Price above a flattening out 50-month moving average. And there's no question the slope here is showing somewhat of a flattening outlook as well. And if these trends were to continue, it wouldn't be shocking in 2022 if we get a bullish moving average crossover, green above blue. These are monthly charts. Now let's look at some quarterly charts and compare 1962 to 1973 to the present day, going back to about 2011 on the right side of the screen. In both cases, again, quarterly chart with the 13-quarter moving average in blue and the 3-quarter moving average in green. Left and right side are the CRB index relative to the S&P 500. At the end of the first quarter in 1973, March 31st, 1973, which was a Saturday, it's probably fair to say that commodities were stronger relative to stocks than what we have in the present day. This is an incredibly weak look here for commodities relative to stocks going back to 2011 on the quarterly chart. But there are some similarities. RSI approaching 50 on the left side, RSI above 50 here. We have price above a turning up 13-quarter moving average in blue, and we have a bullish crossover with the 3-quarter average above the 13 and price above both of the moving averages. So if we just look at the moving averages, this point here, you can make an argument, is similar to this point here. Because here, blue, the slope is still down. Here, the slope of blue is still down. Here, slopes are all up and prices above. Slopes are up and prices above. Therefore, it might be helpful to know what happened next on the left side of the screen from the end of Q1 1973, commodities relative to stocks. In this case, if we fast forward to October 3rd, 1974, so this is 1974 where my cursor is, between that point A here, that we can make an argument is similar to the present day in some ways, and there's unquestionably some significant differences as well. Between this point A and this point B, the CRB index tacked on an additional 60.21% at the bottom of the screen. Over the same period, the S&P 500 lost 44%. Irrespective of all of that, there's no question that the trend in the CRB index relative to the S&P has improved significantly relative to even this point here in 2021. It's also possible in the present day, even if commodities do well relative to stocks over the longer term, that we have to have some type of basing pattern so we could get a break above and then come back down. So there's no question there's a base over here before this big move. We really don't have much of a base on the right side of the screen at this point. So let's take a broader look at some of these concepts and tie them into other data sets in the present day. The VIX of the VIX, $VVIX, still looks pretty tame over here relative to this fear spike back here, and it looks extremely tame relative to the COVID look over here, telling us to keep an open mind about some of those drawdown charts for the S&P 500 remaining in play over the next few days, weeks, and months. So we'll put this in glass half full, but there's no question this topic is glass half empty in a big way. You may remember on April 1st, we said weekly momentum on the S&P 500 was trying to turn up in a positive manner, but monthly momentum had already rolled over monthly MACD in a concerning manner. Common sense told us that if the weekly was going to win that battle between April 1st and April 14th, good things really needed to happen for this to improve and get the bullish cross. That's not what happened. Since April 1st, the last 2 weeks, the S&P was down 57 points 2 weeks ago, and this week ending April 14th, the S&P was down 96 points. So here's the look of monthly MACD as of April 14th, and weekly has not nailed down a bullish moving average crossover. If anything, black is starting to turn back down and is still below zero. Could show a wide array of charts that have this concerning monthly look here that typically leads to poor risk-reward outcomes in the stock market. Let's take a look at sentiment. American Association of Individual Investors, bulls minus bears, chart dated April 14th. Very, very rare to see a move from up here, 2021, to April 14th down here in 2022. In fact, going back to 1990, it's only happened 5 previous times, and in those cases, your drawdowns relatively muted, less than 4%, and your gains in the S&P 500 looking out a year, excellent. The average gain was 18%, the median gain 14%. Now, this move here occurred in roughly a year. Some of the cases in this study, 865 days here, that's not very similar to sentiment in the present day. This is 826 days. This case, and this case look more similar to the present day, and thus might be helpful to see what the drawdowns look in those cases. Next to nothing over here. Market, for the most part, never looked back. Average gain in the S&P 500 a year later, about 24%, the median gain in the same basic neighborhood. Thus, these figures here allow us to put some more hypothetical drawdowns on a chart of the S&P 500. Again, we're doing this for a reason. We want to look at the bullish cases because if we drift away from these lines, then from a probability perspective relative to this study, we're drifting away from these outcomes as well. Thus, based on this sentiment study, you could go back and retest the lows from February and March, and that really wouldn't be out of character. On the concerning end of the spectrum, you may remember in the videos we said up here we had a very, very strong trend and we couldn't draw horizontal lines and go back and hit price. That's not the case anymore. We can draw a horizontal line from price here and go back almost a year and hit price here, which tells us the market is now more vulnerable to a reversal. And the concepts that we covered up here were helpful. Why? Because here, you're less than 5% or roughly 5% from an all-time high in the S&P 500. You're above an upward sloping 200-day and above the 50-day here, which is not unusual when you start from a point like this with a very, very strong trend. So we had an advantage here when the market went down. We could somewhat rely on this strong trend in the rearview mirror. We don't have that anymore. Mathematically, readings in the model right now, this is a vulnerable market. And if we start to move in this direction, especially into this area here, it's quite a bit different from a risk-reward perspective in terms of this move from point A to point B. It doesn't mean we should throw out any bullish hope, but what it does mean is the market is much more vulnerable on the next decline from this point here than it was from this point here. In a nutshell, the stock market bulls need something good to happen, and they need it to happen relatively soon. Here's another read on sentiment, Bank of America Global Fund Manager Survey. Headline like this you would think would be bullish. Global growth optimism at all-time lows. They've got data going back to 1994. That sounds good until you look at these dates. October 1998, December of 2000, August of 2006, July of 08, January of 2019, March of 20, and April of 2022. Let's focus on this date, July of 08, and December of the year 2000. Very, very difficult to make the argument that those are bullish periods because from point A to point B, in the first case, the S&P 500 lost 41%. From end of July 2008, which is this point up here, the S&P 500 lost an additional 46%. Extreme sentiment can be accurate at the early stages of a long-term decline. All this chart tells us here is to keep an open mind about a possible reversal. The market still needs to prove it. And notice we have a data point in the present day that ties us to July of 08, December of 2000. Here's your performance walking forward. Here's your performance walking forward. We also just showed that there's some similarities in the present day between this point here and this point here. And the S&P 500 walking forward from this point, again, we get a negative 40-something return. Now let's look at commodities from a different perspective. Source of this excellent work, Dean Christians. You can give him a follow on Twitter over here from Sentiment Trader, sentimenttrader.com. Back in October, Dean published a very, very helpful study relative to commodities, telling us to keep an open mind about better than expected outcomes using data as of the end of September 2021. That turned out to be very, very helpful because the CRB index since that signal has gone up almost 22%. And you'll remember, we just showed you can make a case that this ratio is similar to this point here in the early 1970s. You can see that same period showed up in Dean's study from October of last year. This is February 16th, 1973. We were looking at March 31st, 1973. Dean was nice enough to forward some updated information relative to his study. You can pause your video player, but the point of the exercise here is, in the present day, he's saying we have something that's similar to this point here, similar to this point here, and of course here's the present day here. It's the only time that something like this has happened going back to 1935. And it's interesting to note where this point is. It's after a breakout following a period of long-term consolidation. Harder markets are typically followed by easier markets. The longer a market goes sideways, the bigger the move we can expect to get. You can see that typically applies to commodities as well. Sideways consolidation for a long period of time, then a trend. Have to consolidate our gains, and then a trend. We've been consolidating our gains for quite some time. So if the updated study from Dean says the present day is similar to this point here, that aligns with this bullet point here in orange. Because in that case, after this big move, there was some consolidation and a lot of volatility in the commodity complex. Having said that, the gains from this point here, looking out several years, were still outstanding. And remember, the updated version of Dean's study only gave us 3 points: this point, and the present day. See, the present day occurs after consolidation here. This point here is after consolidation. This one here is at the end of a move before a period of long-term consolidation. All 3 points are relevant. Dean also forwarded it another way to compare the present day with the past, and you can see the days that are similar. Once again, a lot of them cluster in this general area here, similar to this window here that we looked at earlier. So in this case, we're looking at commodities. The present day looks similar to these points in commodity history. If you do something similar with a similar signal using the S&P 500 index this time, it says that the present day here is similar to this point here, 2007, 2008, and similar to these points up here, 1973, 74. If you know your market history, those are not good times to be in the stock market. Not good times to be in the stock market. This is a bear market in here where the S&P 500 drops somewhere in the order of magnitude of 50%. The same can be said here in the 1973-74 bear market. And these periods here also align with the topic that we've been covering for the past 2 or 3 weeks, that the tape has a defensive bias in it. It's interesting because Dean just recently posted something similar on his Twitter feed. The following has never happened until now. And basically what it says is energy is extremely strong, staples, defensive staples are strong, and defensive utilities are strong during a period when the S&P 500 is vulnerable. And in this study here, he lowers his threshold a little bit to get some historical reference points. And look where they are again. S&P 500 index here. This is the peaking process of the dot-com bust. This is before the peak sometime in 2007, 2008. And this is very, very close to the peak in 2007 and 2008. So the present day up here, going all the way back to 1951 in this case, these are the only similar cases. Not a prediction in any shape, form, or fashion, but it just says something about the market's risk-reward profile, especially if things don't improve relatively soon. Notice in this case, stock market went up for quite some time before the peak in this case here. Here it's already peaked, and here it's already peaked. Look where these periods are again. 2000, 2001, 2007, 2008. We just talked about those periods. December of 2000, global growth optimism. July of 2008. So this data set here, this data set here seems to align with this data set up here from Dean. You're not using any of this to predict anything. It's just part of the weight of the evidence. And really what it does, it helps us keep an open mind about worse than expected outcomes in the stock market. That's it. We still trade the chart in front of us, and we acknowledge that we've also covered a lot of data points and charts in this video that are potentially bullish. So the present day could be similar to these points in here in the 70s. And we know in the present day, 2022, interest rates are rising. Might be helpful to know what was happening with interest rates back here. So in terms of these returns in the lower left-hand corner, this is point A here. This is point B here. This is the same point A over here, same point B here. Here's your CRB relative to the S&P 500 monthly with a 50-month moving average. This is the 10-year yield up here, or interest rates. So in this case, in this window here, interest rates were rising rapidly. But we also have to acknowledge interest rates were rising from 1962 into roughly 1970. So it's also possible from an interest rate perspective that we're here or here or here. And in these instances, rates calmed down, rates reversed sharply. And in those instances, commodities went from outperforming to underperforming, outperforming to underperforming, outperforming to underperforming. If you know your market history, and especially in terms of asset class behavior, there's a lot going on in the present day that looks like the late 1960s, early 1970s. I don't want to get stuck on any one story in here. There's a lot of moving parts. You can see the outcomes can be significantly different when interest rates fall relative to if they continue to rise. And in terms of what rates are doing in the present day, rates have been rising. They rose again this week. We have no signs that the uptrend in the 10-year yield has reversed in any shape, form, or fashion yet. And if you were to look at this chart here, this is deflationary economic fear. So from this point here down to here, deflationary economic fear from here to here. We don't have anything like that in the present day. This doesn't look like a market that's preparing for something like this. So if the market in the present day has a defensive bias, and this chart looks like this, then you can make an argument that the market thinks it's possible, if that defensive bias stays in place, that interest rates could rise further, and that could cause problems for the economy and potentially the stock market. Now, this, like anything else, can reverse rapidly, but it hasn't reversed yet. And you may remember from last week's video, these were the bullet points. These are the things that could cause the market to flip back into a risk-on environment. One of them was interest rates calm down. That didn't happen this week. In fact, there's really nothing here on the screen that's occurred yet. Doesn't say anything about what's going to happen next, but these are the data points in front of us now. We covered these bullet points 7 days ago. Can't really say anything's improved in a significant way here yet either, and that's concerning. To summarize, stocks may be more vulnerable than they appear. What do we mean by that? Well, we're still near the 200-day moving average. We're not far from the 50-day either. But mathematically, we're in a worse spot than we were before. You really can't understate the second bullet point. A shift in rates could change everything, and it could change everything in a dramatic fashion. We're still in these windows, but we really don't have a lot of room. Things did not improve here this week. It's hard to look at the present state of the commodity and bond markets and say that they're expecting anything other than higher rates or continued high interest rates. And thus, that 1970s style inflationary bear market scenario, it's quite possible. It's one of many possible outcomes. We don't want to make any assumptions about who's going to continue to lead. It could be commodities, it could be stocks, it could be bonds. And with rates moving around, the leadership can shift over and over again. It's extremely important not to get stuck on any bullish story, any bearish story, and that relates to commodity stocks or bonds or interest rates. It is important to understand a wide variety of stories, because that helps us keep an open mind about a wide range of outcomes. And we all know it's always true, but maybe now more than ever. The only way any of this works is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.